Monday, December 19th, 2022, Maneco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Patrick Karim and Kevin Wadsworth of Northstar, Badcharts.com. I recommend you go to that website or go to their YouTube channel. I spoke to them back in April about the long-term commodity bull market. They still think that trend is in play, but I wanted to speak to them again to see what they see as important these days, especially in the precious metals sector, also in the British pound. We're going to look at the British pound, what it's doing versus gold, and how it looks to me a little similar to what the Reichsmark was doing just before gold started taking off against that currency in 1922-23. So guys, welcome to the channel again, and thank you for coming on.
Thanks for inviting us. Good to see you.
Yeah, it's a pleasure, man.
Thank you. And just to let the viewers know, Patrick and Kevin are regularly on Kitco. You've interviewed there a few times. You're pretty active on Twitter, YouTube, and you should check out their blog. So I'll start with you, Patrick. So what do you see as important these days, especially for the precious metal sector? We were speaking about it prior to starting the video.
Yeah, look, this is the number one thing that we weren't looking at as closely back in 2019. So when gold broke out versus on its own chart merit in June of 2019, everybody was going nuts. The miners, everything was going ballistic. But what we were actually experiencing was a bear market rally for gold versus SPX. So the capital flows were heavily going into US equities, the SPX, but then eventually gold decided to rally against that. And just that small rally that actually created a wave that morphed into existence, a descending trend line on the gold versus SPX chart. Just that created insane, crazy moves in the miners. You know, we were all crazy. But right now that went back down. But now we have a clear, bigger pattern in play. The momentum of the SPX versus gold has totally slowed down. It's actually turning up right now. And we're attempting to make a run at that breakout line that was hit in 2020 when it peaked, or when gold peaked in August of 2020. Now it's a little lower. So we're getting really close. But for me, until gold breaks out versus SPX, until it's able to be worth at least half of SPX, and the real go time for gold is when gold is worth 2/3 of SPX. That's when you buy the dips, like everything's in your favor. So I wouldn't get excited about anything right now. It looks great, but it's still an opportunity cost area. So you could buy now, but if we fail to break out, then 1 month, 2 months, 3 months, 6 months, like it could drag on, and then your emotional capital erodes. So I'm not stressed at all. I know with proper risk and money management, we can make as much money buying higher than trying to catch these bottoms. It makes no sense to try to catch any type of bottom in the precious metals right now, but we're getting close.
And you, Kevin, what's on your mind these days, apart from what Patrick was saying?
Yeah, there's a lot of pieces to this jigsaw puzzle, that's for sure, and quite a lot of them have fallen into place. We're seeing a lot of favorable movements in the technical charts. For example, silver breaking out versus NASDAQ and S&P and NASDAQ breaking down versus inflation is a big one. We're seeing gold breaking out versus the M2 money supply, which is another big one. We're seeing some key turning points in the precious metals versus other asset classes. And if those turning points are confirmed, and as Patrick said quite rightly, gold versus SPX is the big one, really, then we can say with a high degree of confidence, using historical evidence and historical context and past performance, we can say with a high degree of confidence that the precious metals bull market is declared as being, it's like the kind of go signal, if you like, and we're very close to that point. Some of the signals have already flashed green, but they haven't all quite got there yet. So we just need to be a little bit cautious. As Patrick says, we could get a last minute rejection, last minute turn down. We could get precious metals underperforming the S&P and a sudden turnaround, that is still just about possible. It's unlikely, but it's possible. So we continue to be cautious. And as Patrick said, there's no need to have fear of missing out. We can buy at higher price levels, but we can do so with lower risk. So managing your risk reward properly, you don't need to have fear of missing out. You don't need to feel that you have to catch a falling knife. It's not about catching the bottom. It's about playing the move so that you are buying into the bull market at a low risk, high reward point. And that's what we're aiming to do.
I guess it's like if you see a train and it starts, well, it's stationary, and you go into the train, but it's only leaving in an hour. You're just sitting there, so it's better to come out, and when it starts moving, you just jump on, right?
That's one analogy. I wouldn't advise jumping in and out of moving trains particularly.
Well, they do that in India, don't they? And they go on the top of the train. But
you can do that. I mean, I get your analogy, but I think what I would say is that getting on at the next stop is a safer thing to do, because the train is going in the right direction at least. If your train could potentially,
maybe that's what I meant. Next,
yeah, it's more about making sure that the train's going the right way before you commit to buying the ticket.
So Patrick or Kevin, could you show us this important chart in your guys' view, the gold versus the SPX, and go through it a little bit for the viewers?
Have fun, Kevin.
That part, I've got a bit of a time lag on my camera, so I'll let you go through that.
Okay, I'll do it then. Okay. Start sharing, share screen here, share screen. Okay, here, minimize. Okay, we're going to look at the gold to SPX. Okay, let's do it. We could do it live. Precious metals, minimize that. Ooh. Okay, I have to move that here. Okay, gold to SPX. Where is it? It is right here. Okay, so here it is, Mario. I'm going to remove all my lines. I'm going to remove the volume. This rally here, this one here.
Yeah.
This one here is what got everybody nuts in the precious metal sectors. But what we were living actually was now it morphed into existence, but it was the bear market rally. So the steeper the angle that a break here, everybody thought, oh, it's gold time, it's breaking out. But look, you're below 3-year moving average. You're just waking up above a 1 year. And the cloud is genius. The Japanese person who invented this, Ichimoku, or I'm really sorry, I'll have to brush up on that. But it projects future resistance or support as defined by the congestion area here of price action. Eventually, if you close below it, it becomes resistance. And look, the cloud, it never had. It got rejected here, huge wick, came back down, and then it just drifted slowly, getting attracted by the red Ichimoku cloud. Then we fell below. So, but just that move, it brought gold from 10,000, 1,050 all the way to 2,000. It was crazy, that move.
Yeah.
So it doesn't mean that gold cannot make a strong move all the way here to actually the final breakout line, guys. It's at here about 2/3. When gold is worth 0.6466 of the SPX, that's the true reverse symmetry move that gets enacted. These moves are reverse symmetry. So what happens is you get the same angle of entry in the base, you get the same angle of exit, and those things, they fly, man. Once you're out of these huge bases, out of the horizontal breakout line, and you have these type of fast falls down, you get a fast move up.
There's a reason for that as well. I should just, people might be listening to that thinking, okay, well, but why? If it comes down at that angle, why should it go up at that angle? And of course, it doesn't do it 100% of the time, but the likelihood is that it will do. On more occasions than not, it moves up at a similar angle. And if you just pause for a moment and think why it fell at that speed, it fell at that speed because it broke through a support level. It broke through the 3-year moving average, and it broke through a support line, a rising support line. And at that point, all of the traders who are experienced, and also all of the algos, and this is important, the algos that are programmed to recognize these critical points in time and these critical technical moves, they recognized that, and they started selling, and they sold, and they sold, and they sold, and they realized that what was unfolding was that this was not going to stop until it got down to horizontal support. So that's why it fell so quickly. Every little rally that happened was sold very quickly. And so in reverse, what happens in reverse is that you break above that support level, the support level that you found on the way down, you're breaking above it on the way up. And so the same algorithms that sold it on the way down are buying it on the way up, and the same experienced traders and hedge fund managers and the people who use experienced and good technical chart analysis, as we're showing you here, we're explaining where these points are. These human traders will recognize that, and they will buy, and every time there's a dip, they'll buy the dip on the way up. Yes. So there's a psychological and a scientific reason why it tends to move up at a similar angle to the angle that it came down at. It's common sense in a lot of ways.
Yeah, and I see that since the beginning of this year, actually, gold has outperformed the S&P, so it has done well relative to the S&P. But I guess what you guys are saying is that the real bull market won't start until we break above this trend line, and especially after we break after the pink patch there, right?
Exactly.
I'll show you why, because this defines the capital flows. I keep repeating it. People always trying to fit a narrative on it has to move because of whatever, there's not enough gold miners, like all the narratives. But the price you actually see here, I put the ASA chart. The ASA is the precious metals fund, whole bunch of gold and silver miners since 1968. But look, I overlay it to the gold versus SPX chart. So I'll remove all the noise here. Here. Look at this line.
Yeah.
The capital flows. So this is miners that have different CEOs, that have different regions, different fundamentals. Some of them suck, some of them are good, but it doesn't matter. As an aggregate, when gold is outperforming SPX, that means the whole it's opening the gateways for the precious metals complex. They're getting the funds and they're just tracking that. It's not perfect, but you see that when the funds are leaving, it puts a wall here on the gold miners. So until gold is able to outperform SPX, you're not going to get a rally like that in the gold miners. Forget it. It's not going to happen. And I could put the silver. Silver also behaves like a.
And I guess the gold miners, once XAU versus XAU USD versus S&P breaks out, the miners, we should expect them to do even better, right?
Even better. All right. But that's the tier. When you look from the first to tier approach, like we do, the top two asset classes is gold and US equities. That they're fighting for the money supply, whatever they print money supply going exponential, they're fighting for it. And then after that, once gold breaks out versus SPX, then we're going to look at sub ratios. Are the miners outperforming gold? Because if the miners aren't outperforming gold, I'm still going to hold. Why buy miners? Makes no sense. I'll hold on to gold until the miners could show some teeth versus gold. And that will only happen practically close to the bottom, or when gold actually, look, they're all going to probably break out at the same time. So gold, when it breaks out versus SPX, there's a good chance that the miners are breaking out versus gold. There's a good chance that the miners will also be breaking out versus SPX. All that, it's probably going to happen in a very close proximity to one another. And that's great because that's what we do. It's called weight of evidence. When you see all these things falling into place, silver breaking out on its own chart merit, silver breaking out versus gold, all these things that we all look for, when they start actually happening, then you buy the dips. Then you start adding positions. But this is the biggest misconception in chart trading. And hopefully on your channel, folks will get to express this. All these roadmaps, they only get enacted once we have confirmed breakouts. This is the key word of chart trading, guys. People say, you have a roadmap, nothing's moved. Wait, I drew this line here for a reason. We identify it as meaningful. It's historical meaning. If ever there's a close above that, remove indicators. If ever there's a close above this line here, like Kevin explained, the scientific reason, the mathematical reasons why this is what we want to play us. We want to be in a trade the shortest amount of time and for the fastest gain. Look at the steep angle. That's what we're going. Why would I buy here? Because I love precious metals and I think they have to go up because they're printing money. Look, that's fun, but if you really want to make money, you want to play this. This is what you want to. This is what you want to play.
Patrick, would you be able to bring up the SPX versus ASA chart?
Yes.
Just to. So this is the S&P 500 versus that precious metals fund with a lot of history. And if Pat puts a horizontal line across the top there, you'll be able to horizontal resistance line, what you'll be able to see
Wow,
is,
that's a huge
so what this chart is showing you is, are the miners, is ASA undervalued or overvalued versus SPX? When it's near the top, it's undervalued because the S&P has outperformed ASA to its limit. And when it's down near the bottom, then ASA is, you could say, overpriced or
overvalued. Yeah.
So what we're forming here is a multiple hits on that top line. And if you look at the dates, in 1999, 2000, we hit that top line. We know what happened to the precious metals after the year 2000.
Yeah.
Then look across at all those other hits on the upper line and remind yourself what happened to the prices of gold, silver, and the miners. Even those recent little drops down from that upper line that you can see in the last 10 years, following each of those hits of that upper line there, the miners went bonkers and the precious metals market went bonkers. So ask yourself a question, and the question is, given that historical context, do you think this chart is more likely to break out to the upside and start rising even more, so that the miners are even more undervalued versus the S&P, or do you think it's likely to reverse and move in the opposite direction? I would argue that it's more likely that the miners are going to start gaining relative value versus the S&P. It's not a certainty. It could break out to the upside, but at least technical analysis gives us that warning, because we've got that line on the chart. We'll know straight away if there's a danger sign. If this chart starts to break to the upside, then that is your early warning. That's your instant warning to get out of precious metals, to certainly make sure you don't add any more positions. But if we break down below that line that Patrick's just drawn on the chart there, that sleep mode line, then that's the go line. Below that, we're targeting that bottom line. So below that sleep mode line, the target is the lower of those dotted lines that he's put on there, and that means that the miners and the metals will benefit greatly. So knowing where these lines, people say, what's the point of technical analysis? It's just a load of lines on a chart. Well, a map is just a load of lines on a chart, but without a map, you're gonna fall off a cliff if you're walking in the mountains, aren't you? So technical analysis is the same. If you don't have your lines on the chart, you could fall off a cliff, you could lose all your money, you could get wiped out. Just like people have done with cryptos and weren't using charts and didn't realize, at the start of this year that they should have got out and stayed out. I don't know how many people are now trapped in cryptos, but it's because they weren't using a map. And this is a map. It tells you where we're going. At certain points in time, it'll tell you if we're going higher or lower. And that sleep mode line is just such a line.
Yeah, and it looks like there's a lot of potential for this ASA to outperform. Even if it goes down to where we've been in the last 10 years there, it could still even go further down to where like we were in 2011 in terms of the S&P.
And that a lot of that hinges on, of course, the S&P itself. And are we in the fourth generational bear market since World War One? Now, a lot of the charts are, and particularly the NASDAQ, are already giving the signal that this is the fourth breakdown in a century. We've had three prior generational bear markets in the S&P and in the general equities since World War One in the last 100 years, and many of the charts are now starting to signal that this is the fourth. And if it is, then we will indeed be going back down to that lower line, and that's what gives you your gold at that's many thousands of dollars, and silver north of $100, $200, or even $300.
Kevin, sorry, Mario, before you ask us, we could be witnessing right now the turn, right? These two candles, Kevin, if this line breaks down, we could be doing this show on the actual bottom in metals versus SPX, the miners, right? Yeah. Potentially. But until this line is breaking down, these percentage here, you don't know, right? It could break out to the upside, but if it breaks down below this line.
Just so the gold versus SPX, we need to break through 50. Is that the key resistance right now?
It's 0.5. So gold needs to be worth half of the SPX. So the S&P is 4,000,
Yeah.
gold needs to be 2,000.
Yeah.
If the S&P is 3,500, gold needs to be,
Yeah.
1,750. So
Yeah.
once gold gets to the point where it is worth half as much as the S&P, then from that point we are in very bullish territory, and effectively you can start thinking in terms of a high level of confidence that the precious metals bull market is a long-lasting generational bull market that's going to last at least 5, 6, 7, 8 years, and quite possibly 10, 15 years. That's going to take us to levels that we currently would find hard to believe. If in the year 2000, when gold was $300, I turned to you and said, in 10 years time it's going to be $2,000, you would have been laughed out of the studio, sort of thing. But what I'm suggesting is that kind of move is not impossible. And as we start to see the evidence coming in from the charts, if gold becomes worth half of the S&P, then suddenly the probabilities of gold multiplying by a factor of 8, 9, or 10, that becomes much, much more likely.
We were at I think the peak in 2011. I think gold was 1.7, 1.8 of the SPX. So whatever value you put on the SPX, and that's another cool thing that people don't know. Often people think that gold will peak when S&P bottoms, and that's not the case. So gold will peak when the SPX breaks out on its own chart merit versus gold. But usually the SPX will have been in a rally, because remember in 2009 SPX bottom, gold was already moving up. But gold kept going crazy with the SPX. But the SPX versus gold chart was still underperforming. And then in 2011, that's when SPX broke out, versus gold, and then gold tumbled. So, and usually gold peaks, SPX, when it breaks out of its base, it's going to be at the same nominal value it was when it entered its bear market. So let's say SPX was 4,000 when it broke down, and then gold started doing its thing. And in 4 years, 8 years, 10 years, whenever SPX re-breaks above, and it's going to probably create a huge base, gold's going to peak when SPX is at 4,000. So if you know that gold's going to peak when SPX is at 4,000, then if you have a ratio, let's say of 6-to-1, 5-to-1, wherever you think it's going to be, then you multiply that times of 4,000, and that will be your target for gold. So let's say you think gold is going to peak at a ratio of 1-to-6, then it's 4,000 times 1.6. So that gives you your gold target. And gold essentially
like 7,000.
Yeah, it's a range. On the short term, it could be that. But if we have a bigger bull market and then we go at 1970s type of SPX to gold ratio, then you're looking at 8,000, 9,000 gold. And
I'll show you something else as well whilst you're talking. This is the Dow to gold ratio.
I'm more familiar with that one. I always think it's going to bottom at, I think it's going to go through 0 this time, but we'll see.
Yeah, well, if I think Dow to gold of 1-to-1 is certainly that's the historical sort of level that went. So basically what you're looking at here, just so people aren't familiar with the ratio chart for Dow to gold, this is a chart that shows you that ratio. And as the chart moves to the upside, Dow is outperforming gold. And as the chart moves down, gold is outperforming the Dow. So it's showing you, how those two ratios of one to the other are changing over time. This chart goes back 100 years or more than 100 years. So you can see a very clear cyclical nature. These are the economic cycles. Dow outperforming gold, gold outperforms Dow, Dow outperforms gold, gold outperforms Dow, and so it goes on. So what's happened more recently and of interest right at the moment is that we have hit the upper resistance line. So the next thing to happen is the lower support line. We came quite close to doing that back in 2011, but before we could hit the lower support line with Dow and gold having the same value, we began this sort of up leg, and this up leg, as it happens, has formed a bearish rising wedge. When you get these or bearish rising channel, I should say. So when you get a channel rising like this, it more often than not resolves to the downside. It breaks through the support line and continues down to reach the point that, in this case, it was sort of destined to reach. So the bottom line there is on the, in fact, it's just, you could argue it's a little bit below 1, but it's around about 1. So the question is, you look at the Dow chart and you try and figure out where you think Dow is going to find support as it breaks down, because that will then give you your future value of gold. If you think Dow is going to sort of fall down to, let's say 10,000, then that would be your future target for gold. If you think Dow is going to fall to 6,000, then that's your future target for gold. So it might not do it all in one go in this decade. It might come down and bounce up again, and then come all the way down and break down further in the 2040s. We don't know just quite how long it's going to take to get it to its ultimate low point, but there are some strong technical chart indications that we're going to see this breaking down and moving much lower over the next 5 to 8 years.
There seems to be a long-term cycle from the bottom of the ratio to the bottom of the ratio.
Exactly.
How many years is that? Like
well, it's a 50-year cycle, so
Yeah.
you're talking about the 1930, 1980.
So yeah, that would be 2030, I guess.
Yeah, that would be right. Yeah,
Roughly. And just for the viewers, that's how many ounces of gold you need to buy one Dow. So back in 2000, you needed more than around 45 ounces of gold for one Dow.
exactly. Yeah, and you can look at the Dow futures, which I'm just trying to actually get on the screen here for you. If I can just show you the Dow.
Drop DA, just DJI, Kevin. You'll just DJI. You'll have all the data.
That's the one. That's the one.
On the TVC there. There you go. Beautiful. You get 100 years of data there.
That's the one I was looking for, because I've already analyzed it. So the Dow, if you're looking for support, looking for strong, a strong base of support on the Dow, there's a very strong volume base that sort of comes in at around about 14,000. Now that would be almost unimaginable, for the price of gold to be 14,000, but actually 14,000 is what is that, about 8 times the current value? Well, that's roughly what it did.
Yeah, in 1980 as well. It went from 35 to like 200 in late 74, and then it corrected down to 100 almost. 1975-6, and then it went up to 850, which was 8 times. So
the other point to note from this chart is that the Dow went sideways for 13 years. So the stock markets, and this isn't even inflation adjusted, if you adjust for inflation, then it's a lot more than 13 years. It would have gone sideways probably for closer to 20 years. So factoring inflation in, it's not inconceivable to suggest that the stock markets may not reach inflation adjusted highs for another 15 to 20 years.
I see. And maybe we could move to the British pound and the Reichsmark.
I think Pat's got that, haven't you, Pat?
Yeah.
Because I thought, for the viewers, I thought the chart of XAU GBP, which is gold in pounds, looks similar to the chart of the Reichsmark versus gold back in the early 20s. So just wanted to go over that with Patrick and Kevin.
This goes back to what we were saying before, that the cup and handle pattern that's building out in gold and precious metals in many currencies is, in fact, has been building out for 50 years. If you look at the silver chart, the cup and handle for silver, it's a 50-year pattern. And so it does make you wonder what it's all building towards.
Yeah.
And this gives you a possible glimpse as to what it might be heading towards.
Yeah, so here's the look at that.
If you look at the top in 2011, to me it looks like the top that you had in the Reichsmark at the beginning of 1920, and then you had a little drop there, and then it tried to go up, and then in end of 21 it made another high like we did this year, and then it came down, and then it went sideways a little bit, and then by the end of 2022 was taking off. That's what I thought.
I'm trying to do some drawings. So this for you, this one is it's the
2011.
Okay, 211. Then the breakout. So this is this little peak right here is 2020.
Well, 2020. Well, this year, right? In 2022. Yeah. The
2011.
I think it was the 2020 Brexit top and the
Yes.
2022 top.
So you think we're here about right here,
Yeah,
19,
that's what it
20.
looks like. But I know the times periods are different. That's like in like 4 years, and this has been more like I don't know,
Yeah.
it's been like 10 years. So we could go sideways for a bit longer before the pound dropping sharply versus gold. I don't know if it's going to do exactly as the mark did, to lose so much value.
It's a fractal. So
Yeah, fractal.
what you're witnessing now is just human behavior
Yeah,
and supply and demand, like everything. So
yeah.
because this chart happened, there's a possibility that if this breaks out, we could be looking at gold going nuts. It doesn't have to go parabolic like that. I don't know what's
Well, it could be that the pound drops sharply versus the dollar, and then gold's still going up, and that kind of accentuates it as well.
It's the UK purchasing power. I think, I don't know if I have it. UK purchasing power. Let me check that out. UK, no, it's going to be you guys. It's not UK, it's British
Or GBP.
British. I don't know if I have it.
Is it GBP purchasing power?
No, well, I'm looking. Well, look, it doesn't.
Yeah.
I was looking at the UK purchasing power because gold, that's what it tracks. So it tracks what you said a little bit. It's the British pound strength versus other currencies, the US dollar, but it's more than that. It's also UK inflation. So you have to UK inflation adjust the British pound, and then the inverse of that is your gold chart practically.
Yeah. But the other
So,
thing I wanted to ask you guys, because there are a lot of people on my channel who are not traders, but you said to me before we started the interview that having paper, like savings in paper, is not the right thing. So could you talk about that as well?
savings in paper.
Yeah, like, if you have fiat currency in the bank, I know we're
Yeah.
talking about trading and making profit in fiat currency, but you see eventually also the fiat currencies go down sharply versus gold eventually, don't you?
Exactly. Well, it's a ratio chart. So
Yeah,
essentially, a fiat currency is a ratio chart versus another currency.
Yeah.
Gold is expressed divided by US dollar, so
Yeah.
it's a value. So you always use ratio charts and make sure you're on the one that's performing the best. So if gold expressed in US dollar is breaking out to the upside, or gold, if you see this chart, the UK, the British pound breaking out in gold, or gold breaking out expressed in British pound, then it's a simple choice. All your fiat should be held in gold.
Yeah.
I mean, if you just basically take a look back to 2016 on that chart, if you bought your gold in 2016, 2015, that kind of area there, from that point onwards where it broke out, you know, you wouldn't have done badly if you had just kept your savings in gold. Because don't forget, if I put £1,000, say, or £10,000 or £100,000 in paper money in the bank back in 2015, and then you factor inflation in, so that's 7 years of inflation at an average of, let's say, 5%, and I'm being generous there because the official inflation rate is, let's say, very optimistic. So, that compounded inflation is going to have eaten away that £1,000, and it's probably worth, I don't know, £800, £700 now. Yeah. So why would you do that? Why would you not put it in gold when it breaks out and your £1,000 worth of gold is now worth, I can't actually see the scale there, but it's probably double in terms of paper. So that's what a ratio chart allows you to do. It allows you to put your wealth into a vehicle that is outperforming. Think of it like a horse race. A ratio chart tells you which horse is winning. It's a 2-horse race. You've got one horse in the ratio and the other horse in the ratio. The chart tells you which is the strongest horse. So put your money on the strongest horse. Okay, occasionally the horse will fall, something will happen, but that's on a small percentage of occasions. The majority of occasions, the strongest horse will win the race. And that's using these charts in this way as roadmaps and as indications of health. It's a kind of a combination of, different disciplines, really. It's a bit like being a map maker, but also a little bit like being a doctor and putting the the stethoscope on someone's chest and listening to the heartbeat. You're figuring out how healthy a particular part of the market is, as well as being able to draw a roadmap to tell you where that's headed. So it's a strange discipline, technical chart analysis, but it's a kind of a mixture of those different prediction techniques. And if you know how to use them and use them properly and carefully, you can really greatly increase your odds of success. And if you combine it with proper risk, reward, and money management, then not only can you have the roadmap in front of you, you can make sure that you take tiny losses and make outsized gains, and that's how you grow your net asset value over time. It's not about these clickbait headline grabbing, I made 1,000%. Well, no, you didn't. You only made 1,000% if you put all of your money into that, whatever it was, meme stock. You're not going to make 1,000%. You make on that particular trade, you might have made 1,000. But the question is, how much did you increase your NAV? If you only have a few $100s on it, it's meaningless.
What about so to wrap up? I wanted to ask you guys a little bit about oil, in the energy market, and what you see there. I mean, from what you're telling me, you believe about gold and where it's going. It seems to me that oil as well is going to be going higher, even though we've seen it correcting. I think you guys did something on Twitter the other day, and it was like animated about oil. I think it was that.
That's one of Pat's animations with his.
Because there's a lot of people now who think that the oil's topped and inflation's gonna go down, and but I don't believe that, and because like we said in April in our first interview, we are beginning in the first few innings of like a secular bull market in commodities.
Inflation is going to come in waves. We're not done with inflation. It's going to prove troublesome, sticky, hard to control, and it's going to come back at us. I'm quite sure of that. Just look at the 1970s if you want to sort of see how that kind of playbook plays out. And I'm pretty strongly convinced that that's the type of that we're looking at.
Yeah, it's a back test. So this thing right now, it's back testing this critical breakout line. Look, if this line fails, yes, we're heading into severe deflation, more and more but this is the same type of setup that we've had back in 2000. And especially, you got to remember, from 99 to 2002, the US equities were breaking down. It was the dot-com bubble, deflation, like the whole thing's breaking down. So this is exactly what's happening now. From a cycle-wise, from gold versus SPX, for SPX versus oil, or SPX versus producer price index, this exactly is the fractal we're reproducing. Here was a false breakdown here in the 99 when you think it's the end of the world. Then you had the same, it's actually the same line that stretches. It's that same line. False breakdown, oil's minus $30 here. Remember that stuff? I tried to fill up my pool. I look at my pool, I said, honey, what if we don't fill up the pool with water? I have 60,000 liters. I could put oil in there. Like, I was thinking out of the box, but I don't think that was.
Would have made a mess of your pool, Pat.
Yeah.
That would have been a big cleaning bill.
The neighbors were freaked out seeing like oil tankers that's just filling barrels.
Where's the 3-year moving average on that chart, Pat, just out of interest?
Yeah, I'm gonna pop it up.
Oh, look at that.
Yeah, it's a retest of the 3-year moving average. It's coming in.
Oh, I see.
But here, look here, it was really bad in 2002. So this is a takeaway. Until now, it's in the oil. It is in sleep mode. You see this line here? This line is what we call the sleep mode line. I'm just gonna sleep mode. And you stay clear of oil. I don't care if it's hitting support. Yes, it's hitting support. We've identified it. But until this line here is broken out of, and the 12-month moving average, you don't touch it. So you have to wait now.
The 12-month is that blue line.
Yeah. So until this. Because it's rarely the first move that makes it go ballistic. It could, but it can go like that. It's gonna grind like. But this is it could be in mid 2023 before this really resolves, right?
Yeah.
So the lesson is, guys, no fear of missing out. Wait for these big patterns to play out. And the reason we're talking about oil is because it moved up a lot. Unfortunately, it's just the nature of the beast. When people on podcasts talk about something, usually it's too late, unless you talk to chart traders where they see something coming up, they're looking at a big base. But the move for oil, it was to ride it from wherever this breakout line here at on this close here in 2021 from and you would have rid it from 60 all the way to this reverse mutual move to about $100. That was the move, guys.
I remember when he broke that trend line, and I don't trade oil, but I said, look, it's breaking out. This is a really key trend line. And yeah.
Right. Yeah. So that was the move, guys. A 6-7 year base. They don't come up every often. So you play that. Now it's below the sleep mode line. Yeah. And you stay clear, because I've been showing this on Bitcoin charts and all these other charts, but we're unbiased. So no matter what the instrument is, I love oil. I think it's breaking out versus SPX. So it has the tailwinds that these dips will actually they'll resolve upwards eventually, more than being a waterfall going down. You know, they're dips, but we're not saying buy the dip. We're saying wait for
the breakout
confirmation. Yeah. You don't want to get trapped. It's your money. Why give the market control over your money? You know, wait until the chart proves itself, and you're going to save months of looking at the ticker every day and blaming Mario or Northstar Badcharts why it's not moving up. Guys, wait for the breakouts, the confirmed breakouts.
Great. So guys, thank you very much. Any last words to the viewers? And maybe you could tell them where they can find you again.
Yeah, sure. We've both got our own Twitter feeds at Northstar Charts and at Badcharts 1. We've got a Northstar Badcharts YouTube channel. You can find us on Twitter, not Twitter. I already said that. I'm not wake up, Kevin. You can find us at northstarbadcharts.com. It's been a long day. There you go.
Not for me. I'm just waking up in North America.
Yeah. Yes. For those of you who don't know, Patrick is in Canada and Kevin is in the UK.
I'm in the UK where it's dark outside already, and
yeah, it's getting dark. I'm in the UK as well. So, guys, thanks again. Have a great week, and Merry Christmas and Happy New Year.
And the same to you. Cheers, Mario.
Cheers.
Have fun, man. Ciao, guys.